NVIDIA just reported after hours, and their profit, they beat 51 cents versus 50 cents expected, and their revenue was in line. Now, the 51 cents was still a drop of 50% year over year in terms of EPS. So I'd be wondering, wait a second, if their revenue, because their revenue beat last year by 3%. So if the revenue's up, how's their profit lower? Well, this was a report from August 8th. And on August 8th, they talked about a couple of things, but one thing they note here, to scroll down just a little bit, second quarter results are expected to include approximately $1.3 billion of charges, primarily for inventory and related reserves. Okay, so $1.3 billion, when you have 2.5 billion shares outstanding, that's over 50 cents right then and there. So they're probably in line when adding those things back in. In terms of revenue, only up 3%. From their same report on August 8th, look at all the areas they have. Year over year, down 31, up 61, down 4, up 45, down 66, up 3. So a lot of areas up and down here. Now remember, guys, if you go watch our videos from the past, the one thing I focused on when it came to processors, chips, anything computer related was there was a big surge in demand and a limited supply last year. People's gross margins were insane. Their profit margins were crazy. Why? Very simply, supply and demand. I love supply and demand. It makes things easier, makes things better, makes the world really fair. However, my comment was always, is this a permanent plateau in that demand? And I question that. And you can see from revenue growth. So let's go to our software real quick because I want to show you what I'm talking about here. So this is our software. And again, if you have it, please follow along. If you don't have it, you're crazy. It's less than a cup of coffee per day. So look at their revenue jump from from the previous 12 months to this last 12 months. 19 billion to 29 billion. Yet they only saw a 3% increase year over year in this last quarter in revenue. How is that? How is that possible? Well, things cool down. The demand decrease. Also with supply chains, it's harder to sell stuff when you have limited supply. So don't always assume that a big jump is a permanent jump. These jumps right here, look at their revenue for the last 5 years. 11, 10.7, 11.8, 19.3, 29.5. I mean, this is huge growth in the last 5 years. Is that sustainable? That's the question. So if you're new to this channel, I'm Paul. I'm a value investor. What I like to do, I like to look at the quantitative aspects of a business and decide if I go further and learn more about the business to invest in it. I don't sit there and worry about what the company does initially. There are 10,000 companies out there. I'm going to weed them out based on certain quantitative aspects that I use in our 8-pillar process. For NVIDIA, and for a lot of companies lately, I've been seeing a lot of this. Big jumps in revenue because of limited supply, limited demand and excess supply. Other way around, limited supply, excess demand. That is a temporary issue. It could be permanent in a lot of areas maybe, but for things like this in automobiles, I feel like it's just a temporary thing. So when looking at the future, I don't go based on one fluke or 2 years of fluke responses and results. Just like when it comes to cruise lines and airplanes and airlines, we don't sit there and assume that the time of COVID was a permanent thing. I mean, literally, airlines and cruises had 99% drops in revenue. That's an insane number, but that wasn't permanent. So the same thing goes on the upside. You can't assume that a temporary supply and demand elevation or decrease is a permanent thing. So let's go look at NVIDIA and let's go see what's going on here with the company and look at it from an 8-pillar perspective. So we're going to click on our 8 pillars tab on our software. So a couple of things stand out. The first and last pillars are the 5-year PE ratio and the 5-year price to free cash flow ratio. There's a reason why I don't look at 1-year numbers. 1-year numbers can have fluke events occur, whether it's expenses. Look at the last quarter. They had $1.3 billion in expenses attributed that were temporary. You can't possibly look at that on a 1-year basis and assume that's a normal thing. So you look at long term. But look at these ratios, 85 and 89. This is not a startup. This company is 20 years old. It was started in 1993. It has $30 billion in revenue. Even before COVID hit, it had $12 billion in revenue. So this is not a company that has, in my opinion, amazing growth potential that can justify 85 times and 88 times earnings and free cash flow. So that's the first thing I see where I go, ugh. Second thing, shares outstanding. Now I will say this. usually I hate shares outstanding going up. But when the company is this expensive, all the CFO is doing is saying, hey, listen, everybody thinks our shares are awesome. They're massively overpriced. Let's fund our business that way. There are two ways to fund a business, debt or equity. So when they're releasing more shares, they're funding through equity. That's better than taking on debt. Because if you're giving people overpriced shares, it's funding the future at overpriced levels. I'm fine with that. Now, overall, when a company gets more moderately priced, I want to see them buying back shares and rewarding the investors who've been with them for a long period of time. That's a very important thing for a company to do when the stock price is lower and the valuations are much lower. But overall, obviously, high return on invested capital, which is pretty common in tech, that means they really do a great job of investing the money that is inside the business. Revenue growth, we saw that already. Net income, saw huge numbers, and free cash flow up. So everything here is huge. Now, I don't know how accurate, I'm looking at this going, are we seriously paying a 0.1% dividend here? $400 million. Obviously, they can afford it. Their 5-year average free cash flow is 4.9. Their last year's free cash flow was almost $8 billion. But look at this. Big time profit margin, gross margin of 65%. That means for every extra unit they sell, it adds 65 cents. 65% of that money goes to the bottom line. And the bottom line percentage, very consistent. 30 and 32%, 30% over the last 5 years and 32% last year. So what does this mean overall? Does this mean you should avoid this company completely? Not necessarily. Remember, companies that have high growth potential and amazing moats, those are the companies you should pay a premium for. So what I'm going to do now is I'm going to go to our stock analyzer tool. This is something we created a few years ago. I was doing this on an Excel sheet and all the viewers were saying, hey, how do I get that Excel sheet? So we created the software and part of that was a stock analyzer tool. Every investment is the present value of all future cash flow. We don't know the future, so we have to make assumptions about the future, right? With those assumptions, they're unknown. So we're doing a range. So what the stock analyzer tool does is it allows me to look at number of years of analysis. So I'm going to do 10 years. You can do 1 to 20. But it puts in low, middle, and high assumptions for revenue growth, profit margin, and free cash flow margin. And then we put in what do we think the PE and the price of free cash flow will be at the end of our time period, and then inputting a desired return. Once we've done all that, it doesn't include the balance sheet. It'll spit out a number, and it'll spit out several numbers. But that's basically going to tell us what we think what we should pay for the company today based on what we think the assumptions are. Now, this isn't a go out and do it. It's a starting point for saying, okay, this is in the ballpark. So if you're watching this video, if you've seen a lot of our videos, I do recommend watch this part over and over because this stock analyzer tool is so useful for understanding investing. It really makes you understand that every investment is the present value of all future cash flow. And I want you to understand how I come up with these assumptions. So the first one, revenue growth. Now, guys, 1, 5, and 10-year numbers. They've done 23.8% a year for the last 10 years, 28% and 53% last year, 28% for 5 years. Now, let me put it this way. Let's go to their revenue numbers. What were their revenue numbers last year? $30 billion, we said. Okay. Let's say they did 28%. Let's say they did that 23% a year for the next 10 years. This is very simple math. That means they would do $253 billion in 10 years. Is that probable? Probably not. Is it possible? Absolutely. Everything's possible, but is it probable? In the world of investing, your job is to be conservative and buy the stock when the stock is selling for less than those conservative assumptions. I don't think 23% is a reasonable expectation. What is a reasonable expectation? This is where the guessing game becomes. I will say this. The revenue went from 12 billion to 30 billion. Is it going to sustain at that level? I don't know. But the assumption I'm making here, you're going to be a little bit shocked, but I'm going to show you how I'm doing it this way. I'm going to assume they lose 2% a year for the next 10 years. I'm going to assume that 10 years from now, because 3 years ago they did $12 billion in revenue. 10 years from now, they lose 2% a year. It's roughly 20 to 25%. They're still having major growth in their $12 billion level. Okay? Might be too conservative, but it's just to give me an idea of where we stand. My next one, my middle assumption, I'm going to assume 3% growth a year. And my high assumption, I'm going to assume 8% growth a year. Okay. So I have -2, I have 3%, I have 8%. So I actually have contracting. I'm assuming it's going to contract for a while because what's actually going to happen is if it does contract, it'll probably be more like this as a contraction. All right. Profit margin. Now, when it comes to profit margin, 10 years, over the last 10 years, they've done 27%. In the last 5 years, they've done 30%. And last year, they did 32%. I'm not going to focus on the 10-year number because the last year or two has been very, very good for these chip companies. They could pretty much charge any price they wanted and within reason, of course. So I'm going to sit there and err on the side of the 10-year number. I'm going to go 24, 26, and 28. I'm going to do the exact same thing for free cash flow. Free cash flow margin is the same as profit margin, except involving free cash flow. And over long periods of time, free cash flow and earnings should be very similar. So it's a reasonable assumption to make. And you see right here, they're actually pretty similar here. They're actually, well, except for this last year, the free cash flow number was a lot lower. But other than that, it was very similar. Okay. Now, finally, PE and price to free cash flow. I'm also going to assign the same numbers here for the same reasons. They should be in line. But this is where PE is. The current PE is 45, and the current price of free cash flow is 54. Guys, this is very, very high, and it's still based on really high profit because of the fact they had so much revenue. So I'm assuming the future is not going to be that great. So a company that's going to lose 2% a year, let's assume now it's still NVIDIA. Even though they might lose 2% a year, it's just for my analysis here that I want to sit there and look at that. Do I actually believe they're going to lose 2% a year? No. But I do believe that they'll probably fall. If they do fall, it'll be a quick one and then back to growth again as things stabilize. They could very well have the plateau right here and move on. As I said, they did 3% revenue growth year over year over the last year. So they could very well just have, this could be a completely egregious assumption, which I'm okay with. I'm going to do a PE of 13, 15, and 17. Same thing with the price of free cash flow. Because guys, the bigger and bigger a company gets, it's very difficult to have a high PE. There's less growth. I was thinking about this the other day, and I thought about an analogy. Let's say Tiger Woods is right here, and a new golfer is right here. Which one's more likely to shave 2 strokes off their game? The new golfer or Tiger Woods? Clearly the new golfer. Why? Because Tiger Woods already averages 68 strokes a round or whatever. To go to 66 would be so difficult. But a new golfer who's averaging 150 a round, it's easy for them to go to 148. That's the same thing here. You assign a bigger PE to a smaller company that has more growth potential. But you pay more, in my opinion, for the company overall, like Tiger Woods, that makes more money. So remember that analogy there. Golfer who just started versus Tiger Woods. Which one has better growth potential in terms of their golf game? Clearly the new golfer. Okay, final thing. Oh, somebody sent me a message. Desired annual return. Now in this situation, guys, I'm actually going to be a little bit different here. I'm going to be a little bit lower on my desired annual return for the low side. I'm probably going to do 12.5%, 12.5%, and 15%. And the reason being, this high number, 8% a year, with higher margin and all this stuff, it's a little rich to me. So I want a little bit more margin of safety in there. Because at the end of the day, your goal is to make the desired return factor in some sort of margin of safety. That's why we don't put in the 9 or 10% the market does. Because you might as well then just buy an ETF and stay with the market. So let's do that. 12.5, 12.5, and 15%. I'm going to hit the analyze button. Now again, guys, the stock's currently at 168. It's down 2.5% after hours, down $4. There's going to be 6 numbers that pop up. Low, middle, and high for earnings, and low, middle, and high for free cash flow. A price to reflect our multiples. If it's all green, it doesn't mean go out and buy. What it means is go out there and verify this information is correct. How do you do that? Go read the 10K. Go read other articles. Go see what the future holds, what they're saying about the future. But most importantly, join our community. Our community has thousands and thousands of people who are sitting there looking to invest, and they're like-minded people who want to do research. The best thing to do with thousands of people is go in the chats and see who's talking about NVIDIA. You can actually literally go in there and type in NVIDIA, and it'll show you all the messages that involve NVIDIA. Go in there, have the conversation. And again, this is all for less than a cup of coffee per day. You get all the software, all the 8 pillars, all the 30 years of financial data, and the community. It's an absolute no-brainer, and everything's on your phone as well. So I hit the analyze button. Scroll down. Oh boy. 23 is the low, 53 is the high, 40 is the middle. And guys, guess what? It makes sense based on these PEs. Based on these PEs, I look at it going, yeah, I'm not touching this thing. It's too far away, but I'm going to add it to my watch list right here. I might add it at 55. Notify me. Now I'll get an email, I'll get a notification on the website, and I'll get on my phone. So guys, I appreciate this. If you want to learn more about our 8-pillar process, watch this next video on our 8 pillars, and please don't forget to subscribe to our channel. Thank you very much for your time.